Today I want to talk about what I believe is the simplest and surest way of achieving a good bit of success in the stock market. For purposes of this conversation, I assume you know the most basic facts about stocks. I assume you know that a stock represents a share in the ownership of a company. Hence, stockholders are partial owners of the company. But I am not going to spend any time discussing esoteric market concepts or metrics. The reason I am not going to spend any time on clever stock market concepts is because learning them is not necessary to achieve success. In fact, I am quite confident a relatively ignorant newcomer to the world of stock investing will do at least as well as a sophisticated trader over the long term if he or she simply follows the advice offered today. Your future wealth will not be determined by how well you understand financial jargon and stock charts, but it probably will depend on how soon you start investing and how successful you are in avoiding the common pitfalls that litter our financial landscape. In short, if you start soon enough, keep it simple, and avoid the powerful urge to prove how smart you are, the odds are quite good that you will be successful. In 1973, the first edition of Burton Malkiel's A Random Walk Down Wall Street was published. Very few books about investing in the stock market have stood the test of time as well as Malkiel's writing. The advice in his original edition was very simple. Investors are far better off buying and holding a broad-based index fund than attempting to buy and sell individual securities or actively managed mutual funds. His often repeated quote is that a blindfolded chimpanzee throwing darts at a list of stock prices could select a portfolio that would do at least as well as the portfolios selected by experts. In my experience, this is true. But Malkiel's recommendation is not to throw darts, but to buy the whole market. He argued that what we need is a no-load, minimum management fee mutual fund that simply buys the hundreds of stocks making up the broad stock market averages and does no trading from security to security in a vain attempt to catch the winners. This sounds so obvious today. In fact, Malkiel's insight is the intellectual foundation for the trillions of dollars that currently sit in general equity index funds. But remember, when Malkiel wrote these words in 1973, there was no such thing as an index fund. They did not exist yet. 3 years after the publication of Random Walk, Jack Bogle created the Vanguard 500 Index Trust. And people for the first time were able to buy a fund that simply purchased the 500 stocks of the S&P 500 in the same proportions as their weights in the index. The revolution had begun. In 2023, the 50th anniversary edition of A Random Walk was published. It is my belief that everybody who invests in stocks, or anybody who has some inclination that they may one day like to invest in stocks, should get a copy of the book and commit a week to reading it. Then read it again and again. It is absolutely critical that you both fully understand and fully commit to the central thesis, which I will now repeat for emphasis. You will be far better off buying and holding a broad-based index fund than attempting to buy and sell individual securities. Successful investing in the U.S. stock market is intellectually simple, but psychologically hard. If you start soon enough and follow Malkiel's advice, you will enjoy a handsome return. It is actually very simple, but that does not mean it is easy. Let's look at a hypothetical investor. A 23-year-old young lady reads Malkiel and commits to investing 15% of her $48,000 salary. So she buys $600 worth of VTI every month. VTI is the symbol for Vanguard's total U.S. stock market index fund. The fund simply buys and holds all of the stocks that comprise the U.S. public market. An 8% annual return for the broad market compounded monthly provides her with $1.64 million when she walks away from her job at 60. And this figure assumes she never gets a raise, or if she did get a raise, she didn't invest any of it. Maybe she bought beer and donuts, doesn't matter. Of the $1.64 million, her contributions totaled $266,400. The remaining $1.374 million is a product of the market. If she is lucky and the market yields 10%, she will have $2.8 million. The math is shocking, but simple. What is hard is sticking to the plan for the time required to realize the full benefit of compound gains. It will be hard to ignore the urge to stop contributing to her plan when the market is choppy or when she wants a new car. It will be hard to ignore her shiny boyfriend's advice to sell it all and buy gold bullion and Bitcoin, etc., etc. Said another way, the hard part is not the market, it is human psychology. To minimize these psychological risks, the money should be automatically deducted from earnings and sent to the brokerage firm for investment in the index fund. Dividends should be automatically reinvested. These mechanical issues are very simple to accomplish in 2024. No broker required. In summary, Malkiel explains that buying and holding a broad-based index fund is the simple answer to most people's equity portfolio. The number of people who outperform the index over a 30-year investment lifetime is what a paid Wall Street attorney would describe as de minimis, which is Latin for a number so small as to lack significance or importance. Anybody who tells you different is delusional, does not understand math, or is lying to you. Time and energy wasted on picking winners or timing the market would be much better spent starting a business, advancing your career, or going to the zoo. That's it for today. Please remember to like and subscribe and all that good stuff. And until we meet again, take care.